industry. I think it's important to mention that because that's the fuel behind the industry.
Just a few words just to explain. Public is like the stock market. Private is when I am as a person going to evaluate a company and saying like that's my evaluation. It's not connected to the price of what will be their stock, whatever.
Yeah, exactly. When we look at it's not you as a person. I hope for you.
No.
But it's mostly venture capital firms, private equity firms, or corporate venture capital firms. It could be, but the main difference behind that is that, in opposed to other industries or tech industry, the food tech industry started the funding started from the corporate side itself, not from the financial side. So Cargill, Unilever, Coca-Cola, Nestle, for example, all of these guys were the first initial funding source for those companies. So they, when someone starts something, it builds something according to their needs, right? If Nestle needs something and they're willing to pay for that, they sculpt the company itself according to their needs. So it started from the commercial side, but all of a sudden, I think it was something like 3 or 4 years ago, small niche US venture capital firms joined the party. They started funding new startups, especially in the US and in Israel. But I think it started really slow and small. Something like seed investment or even pre-seed investment, but it started to change the industry itself. And then we saw some small to mid-sized firms that they are more from the general side. So they don't invest in a specific philosophy or specific theme or niche. They invest statistically all over the industry. They entered the food tech industry. And we thought, I think that was one of your questions, the environmental side, the impact side. You have a lot of impact funds, but they're still small proportion out of the industry itself, unfortunately. And now the party is full on, right? Everybody is part of the party. Everybody wants to be a part of that, to take a big chunk or a big piece out of those companies. And we saw the valuation in the last 6 months skyrocketing. Just yesterday we saw...
Not only in food tech, like we're talking about food tech, but in general, right?
In general, it's all about unicorn, right? When Waze was sold to Google, I think it was 10 years ago, it was amazing, $1 billion. But now all of a sudden, $1 billion is a 2-year company, something like that.
Right.
You just have to be a cyber company with an experienced entrepreneur. That's it. You have a unicorn.
Yeah, like Wiz.
For example, And I think, although in the food tech industry it's a bit different, we just started with unicorns, but Redefine Meat just raised $130 million yesterday. It was announced, and Remilk raised 220 a couple of weeks ago. And you can Aleph Farms, they're part of the Kitchen Tech Hub, raised 120. It was 6 months ago.
Wow.
And
so how do you explain these amounts of money invested in something which is initially a small, very, very small idea company? So
I think it's connected again to the public markets, and look at companies are looking for high returns for the same investment, and the alternative they have behind it. Right now, the cost of money or interest rate is negative or close to negative, and they're looking for new and innovative ideas that could generate more revenue, more return, higher return in a shorter amount of time. And actually, the good ideas are very small. The number of good ideas are very small.
Yeah. So you're thinking it's not going to live up to the expectations. That there are very, very high expectations, as we hear. So what would happen to an entrepreneur that gets $220 million, and the expectations are so high. What would happen in the next year or three? What do you think would happen?
Well, I think that's the $220 million question.
Yeah.
And you, as a professional consultant to those guys, knows from previous experience what usually happens. You have 220. It looks a lot, right? It sounds a lot. It is a lot.
It's a lot.
But the problem is that you have to, in order to raise this kind of amount, you build some kind of milestones that you have to accomplish in the next 3, 4, 5 years, even in the next year. And you're trying to push harder in order to accomplish these milestones. And you add new employees, and you buy companies, and you buy technologies, and all of a sudden your burn rate is from 1 million a month to 20 million a month because you have 70 employees. And you have to build up a new structure, a new organization, and all of a sudden 220 is not a lot, and you need much more in order to support the growth that you need. And that's exactly the gap between and the balance, the expectation of these investors that most of them, as we talked, it started with the commercial side, but now we're dealing with the guys that are not familiar with the industry. And they think, listen, 1 year, 2 years from now, we have a running company. It's not going to happen. It takes even the technology itself, the scale up of the technology itself, the pilots behind it. It takes much more time. And then they realize they have to put much more money inside. 220 is it's like a joke for them.
Yeah.
And we saw that in the past. We saw that in 08. We saw it